I've heard the term tax loss harvesting thrown around, and it's usually closer to the end of the year. But an article I read said the tax strategy is actually becoming more popular year round given the volatility in the stock market. So, can you give us a primer? What exactly is tax loss harvesting, and how often do you do it, and should it be done for clients?
Tax loss harvesting is an absolute concept that everyone should be working with their advisor on. And a lot of times, a client will come to me and say, is it appropriate for us to either trim a stock position? Should we take some of the gains that we've earned, and should we lock that in? And should we offset that with losses that we may have inside the portfolio? It is a very common topic in the last quarter of the year. So I would say the discussions about tax loss harvesting will probably increase here once we get into October, November, and December. But I would tell you, 2008, when the market dropped, the average Joe in 2008 lost 35% of their account value if they were fully invested in growth investments. Well, you know what? A lot of those people exited the market. If they were smart enough to get back in by March of 2009, they had a really good ramp up in terms of the market correcting to the upside and putting some money in their pocket. But those that sold out, they are still running. They are still claiming tax losses from 2008. Because remember this, when you sell any type of investment in a taxable account, the most loss you can carry forward in any taxable year is $3,000. So therefore, if I lost $50,000 in a taxable investment account, I am still carrying those losses forward. So tax loss harvesting is a real concept that you need to have your arms around it in terms of how much are you carrying forward? How can you look at those losses in comparison to the gains that you made? And it's a definite discussion that you want to have with your financial advisor, and we're very comfortable having that discussion here at America's Retirement Headquarters.
And I would also carry that forward a little bit more. I think, Chris, is if you think about America's Retirement Headquarters, it's one of the things that makes us stand out is that comprehensive approach. It's the team action plan. So we talk repeatedly about that, when we're looking at taxes, estate planning, asset protection, and money management. But the team also means that we work with a team of professionals because we're not CPAs, we're not accountants. So before you ever make changes of your investments, you always want to talk with your tax professional or CPA and get their professional opinion on your individual situation. But that's an area where we're happy to work with them and take a look at, this one example of tax loss harvesting and to try to figure that out. If you go back to that environment of 2008, I can actually remember that environment. And I remember people coming into our office that, weren't clients at the time. They were at that point where they were looking for a second opinion. And the double whammy effect, even if they didn't sell out, I remember the double whammy effect is those investors who had kind of held on, their mutual funds had made sales. And so what happened was those mutual funds had built-in capital gains that were sold that the client wasn't aware of until they met with their accountant the next year. And then they find out not only did their portfolio go down in value, they actually ended up owing taxes because the issue of the tax loss harvesting was never really looked at, and the realized capital gains that was exercised inside of their mutual funds. Look, I get it. This is just one area, tax loss harvesting, that could be confusing. But if you have a non-retirement account, or even if you have a retirement account, just realize that your investments can be the biggest debt that you have in retirement time. And the reason why is the government considers that to be an IOU. Let alone some of these rule changes that they're talking about with unrealized capital appreciation. Gosh, what a nightmare that could be, depending upon how elections and future tax law changes come out. So we've made it a lot simpler. And what we've done is, number one, is we're more than happy to make an introduction to a CPA or accountant if you don't have one. Number two, we're more than happy to work with your CPA or accountant. So we're all working on the same side of the table to develop a plan to help you minimize that. And the way that we get started is that retirement team action plan. And it's a 4-part plan, but if I look just at the T, the taxes part, what we're going to do is we're going to go through a 25-point checklist. It's called our retirement tax saver checklist. And that's where we're going to look at things like the tax loss harvesting, but we're also going to look at things like, should you consider a Roth conversion before the end of the year? How to optimize your investment accounts for tax efficiency. Which accounts should you withdraw from first, depending upon, what your needs are, whether you have health insurance needs, health insurance cost, things like, should you take money out of your retirement account and pay off your mortgages? These are the type of things that we can go through when we're developing that retirement team action plan. But, this is one of the things that you have a deadline on. So when the ball drops and it's January 1st, this strategy of tax loss harvesting is over. So now that the end of the year is kind of narrowing in and you're not in a rush situation, now's a good time to schedule a call, schedule a time to meet with us. Let's take a look and see if there's some strategies that we can help you implement with tax loss harvesting in your plan.
Is the tax code as it stands complicated? Yes. Is it complicated by design? That is debatable. Is it something that the team at America's Retirement Headquarters can help you with their retirement team action plan? I think it's certainly worth taking a look at. And to get started, to begin crafting that plan, the T, as Nolan pointed out there, does stand for taxes, of course. 419-794-3030 is how you begin that conversation. That's 419-794-3030. Or go to the website, start developing that tax savvy strategy at arhq.com.